Hello and welcome to Building the Premier Accounting Firm. I'm your host, Roger Knecht, and this is a podcast dedicated to individuals that own, operate, and run very successful accounting, bookkeeping, and tax businesses. It's here in the podcast that we address issues ranging from marketing, selling, pricing, client onboarding, client retention, mental health, and so much more. And this is going to be a wonderful episode today. We actually have on as a guest Brannon Poe. He is someone that I'm thinking you're going to be very impressed by. He was basically the founding member of his firm. Brannon's been brokering accounting firms for 20 years. He got his start as a CPA at Ernst & Young. In 2003, he began facilitating accounting firm sales on the East Coast of the U.S. Now, PGA, Poe Group Advisors, his business, has been helping facilitate hundreds of transitions all over the United States and Canada. Now, PGA creates content, including the Accountant's Flight Plan podcast. That's something that interests me, being a fellow podcast host. And he also helps firm owners buy, sell, and grow their businesses. Now, Poe Group Advisors nationally is recognized as a brand that provides content that means really helpful resources for thousands of qualified buyers in their databases. Now, PGA actually sells processes, ensures favorable deals, compatible buyer-sell matching, and quick guided transitions. PGA also helps sellers exit with cash, and buyers enjoy a compatible firm with high content and employee retention. Brannon is a thought leader, someone that I'm excited to have on the show because he's written and is the author of several books within the accounting space, creating content that has been published by AICPA and the CPA Canada. And then in 2019, Brannon actually began working Accounting Practice Academy. It's a virtual workshop that helps accounting firm owners make more and work less and have fun doing so. So, Brannon, welcome to the show.
Thank you, Roger. I'm glad to be here.
Yeah, this is wonderful. First of all, I want to get some history here. Obviously, back in the good old days when you were at Ernst & Young, just give us a little bit of a background as to what drew you to accounting and how you got your start in the accounting profession.
Well, it's interesting. My parents were both teachers, and they were also art teachers. So I had no business background whatsoever growing up, other than my grandfather. My grandfather was an accountant, and he was a part owner in a business, not an accounting firm, but a business. And I just decided, from a young age, I really wanted to do something entrepreneurial. And when I was in the 11th or 12th grade, I was trying to decide what college I was going to go to and what I was going to study. And I ran into an entrepreneur at breakfast who was a guy that I respected. He had like 4 or 5 companies of his own, and he seemed to have this wonderful lifestyle. And anyway, I liked him, and we were talking, and I asked him for some advice, some career advice. I said, I really want to learn how to go into business. I really want to learn how to start businesses. And he said, well, go and get your CPA, go become a CPA. And what will happen is you'll get to work with all these different clients, and you'll see what they're doing. You'll understand their numbers and get to talk with them. And so I thought, well, gosh, that makes sense. And so that's what I did. Now, when I got into public practice, I started at Ernst & Young. It was a lot different than that original vision. And it took me a few years to kind of get back on the path that I originally wanted to set out on.
Now, obviously, a lot of people think of graduating college and in those accounting firms doing the audit work. You got into selling and helping with those transactions that were occurring where firms were acquiring one another. Tell us about that start and how that was for you.
Yeah. So I actually did start as an auditor for Ernst & Young, and I immediately disliked it. It just wasn't suited. It wasn't suited for me. It wasn't what I thought it was going to be. It was a lot more grindy than I thought it was going to be. I enjoyed the study of it, but then in practice, I realized, and I think a lot of CPAs that get out of school and start practicing realize like, wow, there's a lot of, very entry-level work that's nothing like what you study. And I stayed in public practice for about 5 years. And then I got a call from a friend, a high school friend, and they needed some accounting help in their company. He and his dad were partners in a company, and I decided to go over and work for them with the condition that I could do some sales work. That
Okay.
I didn't feel like the accounting was really robust enough. They didn't really need to hire a CPA for that business, but they agreed, and I got to do sales work. And I learned from the dad, who was sort of self-taught, who was an amazing salesperson. And I called on builders and plumbers and contractors, and those are a hard bunch to call on. And I got some experience doing sales work. I got experience doing collections work. And so that kind of rounded out, it gave me a good, well-rounded experience. And then in 2003, I had a friend of mine that bought a CPA firm. And
Okay.
we went to CPE together. And afterwards, we went out and we went to a bar and we were shooting pool. And he says, "You should call this guy. All he does is sell CPA firms." And I said, "All right." So I go home, and this was in the town. It was about an hour and a half from my house. So I get home the next day, and I can't remember the guy's name that he told me. And I looked up the wrong guy.
Interesting. Okay.
So I called the wrong guy, and his name was Howard Holmes, and he was just starting a CPA brokerage business out of Texas. And Howard says, "Why don't you fly down here and let's talk?" And so I did. I signed up with Accounting Practice Sales in 2003. When Howard sold the business, I left the business as well, and I started Poe Group Advisors.
Well, you brought me to the question I wanted to ask, which is what in the world caused you to start Poe Group Advisors? I mean, that's an entrepreneurial thing to do, and you've kind of alluded to it. So obviously the business is sold. Why not just go get another job? Why start Poe Group Advisors?
I was pretty unemployable at that point in terms of my
Okay.
ability to follow the instruction of somebody else. Like I was, once you get a taste of that freedom of ownership, I couldn't go back. It was really, I just didn't want to. I wanted to start my own thing. I always was of the belief at that point that if you want to control your destiny, if you want to control your income and have the autonomy to do what you want, you need to have your own business.
Yeah. Okay. Well, this is going to lead me to my next question, which I'm very excited to discuss with you. Coincidentally, I've just had 2 conversations with firms where they've been acquiring. One was an individual that left the corporate world and bought his own firm. The other was someone that was actually running an accounting firm and chose to, through mergers and acquisitions, grow the business. So some lengthy conversations about their perspectives purchasing other firms. So I really want to get into, first of all, what are some of the factors that you would say contribute to a firm being highly successful that makes it worth selling, that it gives it value?
Well, ultimately, when you buy any business, you're buying a future flow of cash, right? So if you want to know what drives value, it's the future cash flows of the business. Mm-hmm. So you look at profitability, you look at owner hours and owner dependence. Those are the 2 primary things that I think any buyer should be highly focused on. Now, that doesn't mean if one of those metrics is off that you shouldn't buy. It just means that's what you should look at, and you should determine how, when you buy something like that, if you have the skills to change it and improve it to get it to where you want it, then maybe it's a buy. But those are the things that's how you should approach an acquisition.
Yeah.
Is turn this business into to give me what I want from it. What is this business going to do for me? Is it going to give me the income that I want, or can I get it fairly quickly to get it to the income that I want? And can I make it a business and not just a job?
Oh, amen to that. So here's how I usually describe it as I have these conversations, is I view the business and its dependency on the business owner in the light of, is the business a self-sustaining entity that works independently of the business owner on a day-to-day basis? In other words, how much has the business owner extracted themselves from the day-to-day operations? If you're looking at a business that is highly dependent on the business owner, you remove the business owner, you run the risk that the business is going to implode. If you're working with a business owner that has put in place processes, systems, has employees in place that allow the work to be done autonomous from the business owner, acquiring them is a lot easier, because then it becomes a question of how easily they're going to now come into the culture of your business and how you're going to marry those two. And it's also how you're going to then retain the clients that you're actually acquiring so that you can actually have the sustainable income that you're talking about. So let me go this way. When evaluating the valuation of the business, which is perhaps in your opinion the more valuable asset? Is it the client list? Is it the operating procedures that the business has in place to have sustainable business? Or is it the culture, the individuals within the firm that you're going to be acquiring?
Well, I think it depends on the buyer's skill set. Like it somewhat depends on the buyer's skill set and what they want and where they are in their sort of career. For a buyer who is just sort of trying to get started, maybe they buy a small book. If they buy an owner-dependent business, maybe that's okay, and they can create all those systems and processes. If they're buying something a little bigger, the bigger they get, the more you're going to look at the staff, right?
Mm-hmm.
So when firms get to be, let's say, 5 to 10 employees, you're going to put more weight on the employees than you would maybe even the client list, although the client list is important as well. But if you're talking about a smaller firm, which maybe there's 1 or 2, 3 employees, then the staff might not be quite as a big of a consideration as the client list. I think for an entry-level practice purchase, I think the clients are really important because you get referrals from clients. So, growth is likely going to be with similar types of clients. You can get in a rut with the wrong clients if you're not careful. So if let's say you're working at a mid-sized firm, you want to break out on your own and buy a firm, you probably should look for a client base that's similar to the types of clients that you're used to working or comfortable working with. Am I making sense here with that? Like,
because you're looking at what can you do to retain these clients, and if it's a familiar industry service, you're able to more likely retain them because you're able to provide that service that they're paying for. If you're actually branching out into new services, it could be too much of a growth, too much of a stretch for your skill set, and so you could strain things there and perhaps lose the clients that you're acquiring. So yeah, no, I understand what you're saying. Do you have any comments regarding acquisition when, let's say, a bookkeeping business is trying to acquire a tax business? So it's a different clientele. They're looking with the intent of crossing services so that the client base actually now starts paying for 2 services versus 1. Do you have any comments on that? Because what you just described is acquiring a like client base. You're offering bookkeeping services, you're acquiring a bookkeeping book of lists or book of clients, that kind of similarity. How about the opposite, though? You're an accounting business getting a tax business, let's say.
Well, I think then, first of all, make sure you're getting into something that you understand, or you've got somebody on your team that understands, or you can retain staff in the new firm that someone understands.
Mm-hmm.
I'll give you an example. We've had a couple of buyers who are actually not accountants by background. They're financial services. We've had a couple of financial services buyers.
Yeah.
And they want to buy a tax firm or a, general sort of traditional accounting firm. And they think it's easy. Like, how hard can it be? Well, it's actually quite hard if you don't know what you're doing, because if you lose the staff, then what are you going to do? And so I think you got to understand what you're buying, or have somebody, on your team or a partner that can manage that part of the business. There again, I think there's so many different variables you have to look at because every deal is different. But I don't think it's a bad idea to cross over. What might be a smarter strategy is start cross-selling in your existing firm, if you've got bookkeeping clients and you want to get into tax, we'll get into tax and then look at an acquisition.
Yeah.
Because staff can leave. And right now, I think that's a big risk for acquirers. If you're buying a firm and you're depending on that staff knowledge base, that can be pretty risky.
Yeah, I want to stress, I think this is the reason why those three elements are so critical. You're buying the book of business, you're buying their processes, their system of taking care of that client base, and then thirdly, it's the staff. And you've got to look at what are you going to do as you acquire that business to retain each of those. You want to keep all of them. And that really brings me to my next question regarding the operating procedures. What can you talk to, let's say in the firm, they're using QuickBooks Online, you're using QuickBooks Online. The integration is going to be simpler, but what about when it's not that way? You're looking at a firm that's using a different project management system, a different CRM. They're maybe using different accounting softwares. Do you have any experience to share any insights as to what it's like to acquire a firm that isn't using the same tech stack?
Yes, we've had a lot of experience with that. It definitely makes it easier if the tech stack is all the same. It's usually not the case. There's usually some difference in the tech stack. Yeah. And I will say that the software migration for the data has gotten better and better, especially
True.
with tax software companies. It used to be very glitchy and there was a lot of manual cleanup that had to be done after a migration. That has gotten a lot better. And I don't think I would be too afraid of that. I think the bigger issue there is just staff training. So, often if you're an individual buyer and you're buying a firm that's, 5 to 10 people, well, guess who's the easiest person to retrain? It's the owner. You retrain one owner versus 5 staff people. So a lot of times if there's, an acquisition, let's say somebody buys another office, they won't actually migrate the software right away. And, transition, what we find is that there are a lot of things that people intuitively do as they approach a transition. And unfortunately, intuition can often lead you down the wrong path. For example, most buyers come in highly concerned with client retention. And yeah, that's important. Obviously, you got to have clients you got to maintain the client base to maintain the business. But we always tell people the first thing you should focus on when you buy a new firm is your employees, your new employees. People are going to be scared. They're going to be nervous. And they're going to wonder what you're going to be doing with this business and how that impacts them. And, some people who are fearful will, they'll go to that place of like, oh gosh, am I going to lose my job? Is my pay going to change, or my hours going to change, or the work I'm expected to do, is that going to change? And so they have all these questions, floating around their mind, and you've got to develop relationships and give them some comfort, because if you don't, then they might get scared and go somewhere else. So as far as like systems changes, that's actually pretty low on the list of things that they need to prioritize when you're buying a firm. It's definitely a consideration, but that can be dealt with. Sometimes that can be dealt with when things have slowed down and the dust has settled a bit from the people aspects of transitioning a firm.
Yeah, normally, and this is my experience, is basically you want to focus, like you're saying, on the clients because of the client acquisition, retaining those. You want to focus on the employees, making them feel like they have a place, that they're going to be involved, and that stability there. The integration into the culture becomes very essential because that's the long-term win if you can. But the migration of the interfaces, the tech stack and so forth, those can be as they are. They're working now. I mean, the firm is obviously functional, so let's keep it that way. And you could, down the months, look at more deliberately and intentionally how you're going to do the migration and integration. And then obviously it's going to be smoother because it's less hectic and chaotic. But I will add to that whole thing, it always takes longer than you expect. It's a more laborious thing that I think it appears on the surface. So just wanted to throw that in there. So This brings me to the question regarding, With you doing these transactions, what advice would you have to the seller? And then I'm going to ask equally, what advice do you have to the purchaser? What are your insights for each of those?
Yeah, for the seller, I think it's, the first decision the seller has to make is when. When do I bow out? When do I want to exit? And unfortunately, that's not always an easy question for them to answer. It's a very hard decision. And there's a lot of emotion attached to it. It's a big lifestyle change. If you're talking about a retirement, sometimes it's easier when there's like a career change, another business opportunity, or even a job and a really good job that comes up that you want to take. But that timing is important, because if you wait too long, then your practice can start to decline, and that's not good, or you could get really burned out. If you go too soon, then that can be problematic as well, because buyers really pick up on that. And a lot of sellers, again, to the idea of intuition, a lot of sellers think, well, gosh, the longer I stay in this practice, the better it's going to be. And our experience has actually been almost the opposite in most cases, where you really need a pretty quick handoff. So the seller's involvement after the closing doesn't need to be that lengthy. Sometimes the seller being involved in the practice for a long time after the closing can be problematic. And for example, clients don't know who to go to, staff don't know who to go to. It can be confusing. If clients are used to working with the seller, they'll walk in the office and they'll want to talk to the seller, and then the buyer doesn't have an opportunity to bond with that client. So
exactly.
It's again, intuition. So sellers, you don't have to stay on for 5 years to make it work. You need to pick the right buyer who's capable of running the firm, and then you can get out quickly.
Yeah, I appreciate you bringing that up. I know that there's a lot of conversations that have happened to be around this idea of what's that transition period. Is it a clean break at the time of the sale? Boom, they move on. Is it a 6-month, 12-month? What type of transition is going on there? So I appreciate you addressing that. What advice do you have for the seller? For the purchaser?
For the buyer? For the buyer, get the right practice for you. Like we had a buyer that was like, well, I don't want to pay this much for this practice, and starts picking it apart and trying to negotiate a great deal. And nobody wants to be taken advantage of on a purchase. But the question is like, well, gosh, if you don't think it's worth having, why do you want to buy it in the first place? And I would say do some planning. Like, what are you looking for before you go out and just look in the marketplace and start kicking tires? Think about what you want, and think really intentionally about long term. What do you want your practice to look like? And it's like Stephen Covey says, you begin with the end in mind. And you may not want to buy a practice that's going to be that ultimate where you want to go with your career, but what's going to get you on that right path? What kind of practice? What kind of clients do you want to serve? What type of work do you want to perform? What kind of pricing model do you want? Think about the fundamentals, because I can tell you from, and this too, Roger, in consulting with firm owners, a lot of these firms are not really well run. They're not pricing their products properly. They're not taking time off. They're working too much. Before you go and buy, think about what you want and what you want the business to do for you long term. And, think about those fundamentals, because if you can get the fundamentals right, if you can get the right clients, the right pricing, the right staff, if you have a vision, and that's really what I'm talking about here, is what is your vision? And can you clearly articulate what your vision is? And you need to do that before you start, thinking about acquisitions. It needs to be strategic.
Yeah, the analogy I'll give is it's similar to purchasing a house or a car. It's not so much what you need now, it's where you're going to go. If you're planning on having a family of, say, 3 kids, 5 kids, maybe this little convertible 2-seater isn't going to cut it. At the same time, if you're planning on buying a vehicle to tow around recreational, let's say boats or whatever, maybe that little commuter economy car isn't going to cut it. It can't pull that type of stuff. So you've got to, like you said, with the Coveyism, you've got to plan and look forward and begin with the end in mind. And I think that helps as you're trying to assess what you're going to acquire. So excellent advice there. I'm going to ask two more questions regarding sales, and then I'm going to transition into something else. The next question is regarding the valuation. There's different thoughts. Is it top line revenue? Is it EBITDA based? Is this something that I should say is 0.9 of revenue, 1.3 of revenue? I mean, how do you actually say to both the buyer and the seller what's the range that we're going to begin with?
Yeah, so the rule of thumb in the industry is a 1 times revenue, and that rule of thumb has been around since I started selling firms 20 years ago.
Yeah,
and I think I've done a lot of sort of thinking about that, and why would you base it on revenue? Why wouldn't you base it on EBITDA? Now, does EBITDA influence the multiple, what that multiple might be? Yes, it does. And we've seen practices go for less than 1 times, and we've seen on the really top end, we've seen practices go for about 2x.
Yeah.
So there's a lot of variety, and what you have to look at, like what I look at, is how many people want this firm. It's a supply and demand equation. Okay.
Yeah.
But why is it based on revenue? And I think the answer there is because in a fairly small practice, under $5 million, let's say, in annual revenue, the cash flow to owner is a fairly malleable number. We had a buyer. I got a really good example of what I'm talking about. We had a buyer from Chicago years ago, bought a practice from us in North Carolina. And the practice in North Carolina was very well run. It's very efficient and highly profitable. I believe the profit percentage was about 60% of revenue. So the cash flow to owner was about 60% of top line revenue. The buyer had a CPA practice that he sold in Illinois. And I believe he was running 45% cash flow to owner. So that was his normal run rate, which is still quite good. And we ended up selling the owner that was at 60% cash flow ended up buying another practice from us in another city a couple of years later. And when we came back to these two owners, the original buyer who bought the practice in North Carolina, guess what his profitability was? It was about 45%. The seller who was at 60% and bought a practice that wasn't performing quite that well, years later was also back at 60% in his new firm. So the profitability follows the owner, which makes sense because what determines the profitability of a practice? It's pricing, it's mindset things. It's how you operate.
Yep.
And so I think that's why they're based on a multiple of revenue, and that makes sense.
It does. Yeah. The thing I would add go ahead, do your but.
Yeah, no, I was going to say, back to your question on what drives that value, it's a supply and demand. So profitability is going to create more demand. Location is going to create more demand. Sometimes the size, there's some size. If you contrast $1 million firm with a $5 million firm, there are more buyers that can buy at $1 million than there are at $5 million. They're capable of running that practice and also capable of coming up with the capital to acquire. So, we look at a lot of those things that are market-based variables.
Yeah. So first of all, you're bringing capitalism to the table. A thing's only worth what somebody else is willing to pay for it. So I don't care what it is. It goes down to supply and demand. So we start there. I like that you pointed out that it begins at that 1 times revenue. I think we got to have at least a starting point, both the buyer and seller, to kind of assess, okay, where are we going to go from here? You've got the supply and demand element. And then from there, you just need to look at the risks and the plus. Obviously, if you've got 60% of revenue going to the owner, that's a plus. We're we're doing well there. If we've got, let's say, employees that haven't been around for a while, they've not been with the firm for, say, multiple years, nobody's got a particular expertise, nobody has, let's say, a particular relationship with the client base, well, maybe we're going to say that as a risk, and we're going to now down the number from that one multiple. So all of a sudden, what we do is pluses and minuses, risks and valuations, and all of a sudden, we're going to come to this determination where the buyer thinks that I'll pay 0.9 of revenue, and the seller's going to say I want 1.1, and that's where the haggling begins. So I think this is really helpful for our listeners just to understand what that kind of looks like. So here's my next question. A lot of businesses have actually transitioned recently into kind of a virtual type business model, and the relationships with their clients aren't such that they're local, that they're visiting them on site, those types of things. How has that affected the accounting business as an industry and the valuation, the client book, client retention? What are your insights regarding, virtual firms, how attractive they are to buyers, that kind of a thing?
Well, I love the virtual firm owners in general. I think I'm going to make some really broad statements. They tend to be more entrepreneurial.
Okay.
That's been my observation, is people who start and run virtual firms tend to be more entrepreneurial, and they tend to grow faster. We've seen a lot of the people who start virtual firms are really good at business development, and therefore you see a lot of growth. And what's interesting is as they grow fast, they realize they need structure and management systems in place more so, and that might not be always the strength of the founder. But they're valued well in the marketplace. I think it's changing the profession in a very positive way, because these more entrepreneurial owners, they're out there innovating, and all the software companies are catering to them to help them do what they want to do in the profession. I think it's making a really positive, albeit disruptive, impact in the profession.
Interesting. No, I love it. I appreciate your optimism for it all. So what's your biggest advice for someone that's starting a new practice or has just acquired a new practice?
Well, my biggest advice is actually plan. Like, spend some time planning. It's a cliche almost. You work on the business and not just in the business, but it's just so true. I see so many firm owners just get caught in the weeds of the day-to-day of their businesses, and you've got to figure out some kind of way to zoom out, think about the bigger picture, and build your business with intention. Whether you bought it, you starting, goes back to like what I was talking about with vision. You've got to constantly revise your vision, and you got to think about, hey, is this what I want? Because whatever vision you have, getting there is not going to be a straight line. So you've got to iterate and innovate and alter the plan frequently. So you need some sort of regular strategy time.
Yeah. Okay. What advice do you have for someone that wants to look towards selling their firm?
Again, plan ahead. I've had firm owners reach out to me 10 years prior to sale and get us to take a look at, how their practice would look to the marketplace. And I think that's a really valuable thing to do, because, if you've got a 10-year period, you can have plenty of time to move into the direction that makes the firm more marketable. Perfect example is, and I've seen this kind of become more and more common, smaller firms really aren't doing much audit work in the United States anymore. And it used to be that a lot of smaller firms had a little bit of audit work, or, it was usually less than, it wasn't the lion's share of their business, but it was a fair portion of it. And the sooner you get out of that work, the better. if there's something you need to prune or something you need to change, or if you have an employee that's a problem. If you've got a problem employee, it's not something you can fix a year before you sell it, because that can be disruptive. Buyers don't want to see that risk. So, there's risk if you have to prune off a piece of the practice that nobody wants, like audit work.
Mm-hmm.
There's risk and uncertainty if you've got an employee problem that bubbles up, a month before you close the deal. So, most owners, they know where those risks are if they just took the time to think about it. So the sooner you plan and the sooner you take action, then you're going to build a practice that's more marketable.
Yeah, this is going to sound somewhat funny, but I'm sure you can relate to this, as all of my listeners, I'm sure, can as well. One of the biggest things that we say to our clients, and sometimes we just do the same, is I find that people are commingling funds. And so if you're going to be selling your business, you got to pull all those things out, paying for the house, RV or whatever, these personal things that just need to come out. And we all know better than that. And at the same time, I'd also say, as you're preparing to sell the business, is have in mind what you feel that exit valuation needs to be and work towards it. If you're feeling like your business needs to be a certain amount, well, you know what the numbers are that are going to be used to actually determine the valuation of your business. Well, work towards those and build the business with that end game. And once you get to that point and feel that it has that valuation, then you're going to get more in line. You're more likely to get what you wanted out of it. And then the other thing I would also point out is you need to figure out in the transition, how quickly are you going to walk away? We talked about that earlier. You've got to recognize as you're leaving the business, how quickly this acquirer is going to be able to run the business, without you. So you've got to figure that part of it out. And then lastly, what I would mention is as you're running the business, I think it's common, like you're describing with employees, of having some deadwood in the organization. Sometimes it's family and friends, and you just kind of employ them out of nicety. It's kind of nice to have so-and-so on the payroll, and I'm helping them out with their life. Well, the new owner is not going to want to do this, and they don't see that value. Well, like you're describing, you've got to do a little bit of pruning perhaps beforehand, and maybe those hard conversations are better to have long before the firm's put up on the marketplace. So great advice. I like all of that. That's very good, and I think it's stuff that we can all relate to. So I'm going to switch gears now because I know you've addressed this. This is one of the a favorite topic of mine. I do it in a lot of the presentations that I give, and it's talking about unplugging and going on vacation. I know that a lot of us are workaholics, myself included, and so we are quite passionate about what we do. We tend to put in that long time, especially when we're growing our businesses and such. What do you have to say about unplugging and having permission to actually go out there and enjoy life?
Well, it's it's a great topic. I'm glad you brought that up, and you mentioned that mental health is a part of what you guys do, and it's so important not just for the mental health, but I think perspective. And one thing you have to realize is taking time away from the business is not going to hurt the business. It's actually going to help the business. So it's not just this selfish, like, hey, I need this time. It's actually helpful. And what it does is it gives you perspective. I have a story. So I had a CPA call me, a fairly younger person. I think he was probably, I'm going to say 40. And he said, I want to sell my business. And I said, well, tell me what's going on. And, he sort of had this list of complaints about just his inability to do things with his family and just feeling burned out. And I said, well, do you enjoy practicing? And so, I do. I like my clients. I like the work I'm doing. Love my team. He had a lot of positive things that the fundamentally important things about owning a business he enjoyed. He was just running himself ragged. And I said, well, when's the last time you had a vacation? And he said, it's been a long time. I said, well, I think before you sell your business, go book a week somewhere and don't take your computer with you. Don't take your smartphone and just go. And, I don't know what you like to do on vacation. If it's sitting by the pool and reading a good book, or if it's, doing something adventurous, whatever it is, just do it. And that guy's still in practice. So, the other thing it does, not just to refuel you, but it gives you perspective. When you back away from the business, it goes back to what I was saying about zooming out and getting a different, being able to work on your business. When you're so caught up in the day-to-day, you don't see things from the right perspective. You're seeing them um, and you get into this habit, right? These habits form, and they're hard to break because humans are very habit oriented. So when you pull yourself out of the business for a vacation, um, you detach from it. And then when you come back in, you've got a different perspective. And sometimes the problems that you thought were big beforehand, they become simple when you get back. And the only way I can explain, the only way you can really understand it is to do it, and really do it. Like, don't check your email. We've actually written a book, and people can download it on our site, called The Unplugged Vacation. And it's a short little book. And if you've not done a really proper unplugged vacation, I highly recommend it.
I love it. No, I appreciate you mentioning this, because one of the things that I really stress, I do this in my presentations, I do it with my clients, is this whole idea of unplugging, as you say, from the business. One of the things that I think is a very telltale sign is, when was the last time that you took a day off and saw how the business operated in your absence? You know, what decisions couldn't be made until you returned, what things didn't get done because you needed to do them. And that becomes a very telltale sign of what needs to be delegated and what responsibilities need to be passed along. It's very informative for the business owner to kind of step away, whether it be for vacation or going to a conference. You need that independence, and your business will thrive when it's no longer relying upon you when it's looking at its day-to-day operations. And to add what you shared, I do go through a process where I encourage people to do an unannounced, say, 3-day weekend, take off that Friday or that Monday, and go do something, whether it be for the business or for leisure. Just don't go into the office, and see what happens in your absence. And then eventually get the gumption up to take a week off, take 2 weeks off. I knew someone that actually did a sabbatical for 3 months, leaving the office and coming back, and it was having key employees that allowed them to do so, because there were processes in place, key employees that knew what needed to be done, and she was able to kind of step aside and take care of something that she needed to give attention to. And for 3 months, the business existed without her. And that's what we want to get to, is that self-sustaining business that I spoke of earlier. And as for the vacation, I'll just real quickly mention this. When I present, I always point out that there's been studies that show that what we ideally need as individuals is a vacation, something we can look forward to about every 8 to 12 weeks. The psychology behind it is the anticipation prior to the event is actually what is, let's say, beneficial or helpful. It's not the actual time off or vacation. We typically do a lot on those and burn ourselves out. But the studies were showing that it's the anticipation for the actual time off that's beneficial. So just a lot of things there that I could share, and I appreciate that we've had this part of the discussion. So here's what I'm going to do. Brannon, I'm going to come back to you for a closing thought. But before then, I want to just kind of go over a few things for the listeners. One, I want to point out my summary of this. I think it's a great conversation, but also share some gifts or things that the listeners can take advantage of. So everyone listening, go to the episode description. And in the episode description, I'm going to have some information there regarding this Poe Group Advisors free resources. There happens to be a firm growth guide that you can take advantage of. And we'll also see if we can put that information regarding the unplugged vacation so that you can take advantage of those 2 items. And then in addition to that, we'll also provide you information regarding the turnkey business plan for accounting firms. I loved the advice that was given earlier by Brannon, where he was talking about when you're beginning your business or working on your business or acquiring a firm, what's the business plan? What's the end game? And so if you've got a good business plan there, that really helps make the decisions a lot clearer. And so the turnkey business plan is something you'll definitely want to take advantage of. And then lastly, there is also there where you can get a business score. This is an initial valuation of your firm. You can literally go there and with this receive a dollar, kind of like a thumbnail imprint of what your firm is worth. And I think that valuation will be very telling to a lot of individuals. And I would encourage you to go get that. That's something that you can use as a kind of a, here's where we are today and where we need to go next type of analysis. And so I encourage you to go to the episode description and there find the information you need to receive your own business score, and with that, your initial valuation. Now, in addition to that, as a summary, I just want to point out this was a wonderful conversation. Brannon has excellent perspective, having sold firms, been involved with the mergers and acquisitions of these over so many years, to share with us his insights of how to actually start with the valuation and where do we begin with what the company is worth, whether we're selling or buying, and some of these insights as to what really has value within the organization. Is it the client book? Is it the processes and organization that the company is running as we're trying to acquire them? Is it the employee, the staff that we're having? Where do we want to prioritize our efforts as we acquire them in retaining the book and making that transition, keeping the employees? And all that discussion I thought was very, very helpful. I also really appreciated the conversation as we then moved into virtual firms. I think that's so much of what the business model today consists of, and understanding that that's a good thing and that there's a lot of opportunity in the virtual bookkeeping, accounting, and tax space is encouraging. So that's something that's very helpful. I also like the fact that we were able to talk about mental health and unplugging. I really do feel a lot of people just need permission to be able to take that time off, and understanding that building a business that's autonomous from us is the goal is very, very helpful. So some great conversations, some helpful things here, insights for the seller, insights for the buyer, great information. And I really appreciate Brannon sharing all those little insights with us. So first of all, Brannon, thank you. And second, what are your closing thoughts?
Well, I think it was awesome, Roger. We covered, like you just said, we covered a lot of ground. And I think the biggest thing is going back to just planning, just plan. Like you mentioned your business planning tool. I don't know that many accountants have a business plan, and man, it works. It's not the physical document that's worthwhile having. It's the process of going through that planning and vision building. And just work on the business, not in the business. That's my closing thought.
I love it. I love it. Excellent advice, and sound advice, in fact. So with that in mind, let me just kind of go over a few specifics here for you as the listener. First and foremost, there's a few resources, or a number of free resources that you can take advantage of in the episode description. Go there for all those things, as well as what was shared earlier as part of the offer today. Second, I want to invite you to GrowCon. It's an annual event for owners of accounting, bookkeeping, tax firms that you can attend. It's each and every May, and as an event, it's meant to actually help you work on your business, hearing from the experts, visiting with your peers, and actually seeing what it is that you can be doing to build the premier accounting firm in your area. In addition to that, I want to invite you to subscribe to this podcast. If you haven't already, set your reminders, get those notifications as to when we come out with a new episode each and every week. It's here that we have those experts on the show to actually give us insights as to what we need to be considering as we're running our business. And then lastly, the episodes that we've had in the past, go binge watch them or listen to them. They've happened to cover a variety of topics, many of which I'm sure will be of interest to you. You can go to our highlights page, and on our highlights page, see what it is that as a group, a cluster of episodes you would want to listen to. Just go to universalaccounting.com, and there in the podcast section, find the highlights that you would be interested in most. And then as for these topics, these principles that we're discussing each and every week, if you'd like to apply them in your business, reach out to us here at Universal Accounting. You can contact us by going online to universalaccounting.com, or you can give us a phone call at 801-265-3777. And always remember this, if it is about accounting, it is universal. Take care, have a great day, and be safe out there.